You. Yeah, you with the debit card in your pocket. You're about to see why the bank building downtown is 40 stories tall, while most savings accounts pay 0.01%. Banks have used the same fractional reserve system since 1609. Here's how it works. By the end of this video, the math behind your ATM will make sense, and you'll see how the model is structured to operate. Let's go. First, raise your hand if you think this. $100 goes into the bank. The bank stores that $100 in a vault. When you ask for it back, they hand you the same bill. That's the version most people learn. Here's the operational version. Think supermarket. You walk in. You give me $100 to hold. I write on a napkin. I owe you $100. That's your balance. You leave. Your $100 bill is in the register. For about 30 seconds, your friend comes in. He needs $90 for a bike. I use your $100 bill, keep 10, give him 90. The cash leaves the store. He buys the bike. The bike shop owner deposits that $90 with me. I write a new napkin. I owe bike shop $90. Then I lend 81 of it to the next customer. Look at the napkins. I owe you $100, I owe bike shop. $90, I owe shoe store. $81, total recorded $271. Cash in the register, $19. One $100 bill created $271 of account balances. That's fractional reserve banking. The key detail most people miss. The system runs on records, not cash. The bank's obligation is the napkin. The cash just moves. Now the question everyone asks, what if all the napkin holders show up at once? That's a bank run. 1933 was the last major one. The FDIC was created after that to maintain confidence in the record system. Because if everyone demands cash at the same time, the cash isn't there. That's the math constraint. So if cash isn't the product, how does revenue work? JP Morgan reported $49 billion net income last year. That's $1,573 every second. There are 4 revenue systems. 3 of them are built into the flow of money. System 1, the rate gap. You deposit $1,000. The bank pays 0.01% interest. That's 10 cents a year. That same $1,000 gets lent out on a credit card at 24%. That's $240 a year. The difference is $239.90. You get 10 cents. That gap is called net interest margin. It's the main revenue source for most banks. Here's how rates get set. Not by what banks earn on loans, by what depositors will accept. If 0.01% keeps deposits in place, there's no structural reason to raise it. The gap becomes profit. In 2008, when policy rates hit 0, deposit rates dropped too. Deposits stayed. System 2. Service fees. $35 overdraft fee, $3 ATM fee, $12 monthly fee. These aren't penalties. They're priced services. U.S. banks reported $7.7 billion in overdraft fees in 2022. The data shows accounts don't close after fees. The cost and hassle of switching banks is higher than the fee for most people. Pricing models reflect that. System 3. Settlement float. This one is technical, so most coverage skips it. Your $2,000 paycheck gets sent Friday. Your account shows it Monday. That's the settlement window. For 2 days, the receiving bank has your $2,000. Banks lend to each other overnight at over 5% right now. 2 days of interest on $2,000 is 58 cents. Multiply by roughly 70 million paychecks each Friday. That's $40.6 million generated every weekend. from funds in transit. This is called float. It's the revenue from the time between deposit and availability. Wire transfers cost $30 because they settle same day. No 2-day float period. The fee replaces that revenue. System 4. Loan creation. This is the big one. You buy a $300,000 house. You have $60,000. The bank doesn't move $240,000 from a vault. The bank creates a $240,000 deposit in your account. That deposit didn't exist 10 seconds ago. You now owe $240,000 plus interest. The bank records a $240,000 loan asset. 97% of the money supply exists this way, created by banks when loans are made, not printed by the government. This is credit creation. More loans means more deposits in the system. More deposits chasing the same houses pushes prices up. The mechanics. You don't borrow existing money. The loan creates the deposit. Your signed loan agreement is what allows the new money to be recorded. Sveriges Riksbank started this system in 1668. The accounting rules haven't changed. Why do banks spend $4 billion a year on advertising? The system runs on 3 inputs. 1. Deposits. Under current rules, $1 of deposits supports about $10 of loans. 2. Settlement timing. Faster payments mean less float revenue. Services like Zelle and FedNow cut the settlement window. That reduces float. 3. Account stability. It costs hundreds to acquire a new customer. The lifetime revenue from fees and interest is in the thousands. There's a 5th system, interchange. Every card swipe, the merchant pays 1.5 to 3%. That fee gets split between Visa, MasterCard, and your bank. It totals $116 billion per year. The cardholder generates the transaction. Here's the behavior model. Depositors who check rates move money. That movement is tracked as a cost. Accounts that stay put generate margin. Move $50,000 from 0.01% to 4%, and the bank forgoes $500 a year in margin. If 10,000 people do that, that's $5 million in margin pressure. The architecture is optimized for deposit stability. Friction is a measurable variable in that model. 3 structural facts to know. 1. Payment speed. Real-time rails remove float. That's why there was industry pushback on FedNow. When your paycheck posts Friday, you get it. Friday. 2. Rate spreads. The difference between 0.01% and over 4% is the behavior gap. On $10,000, that gap is $400 per year. 3. The accounting. Loans create deposits. That's how the system is designed. Final data point. Bank buildings are tall because balance sheets are large. Balance sheet size comes from loan assets and deposit liabilities, not from cash in vaults. The system is now documented. If this clarifies how the system operates, that is the function of the analysis. Clear mechanics lead to better decisions. Check your current savings rate. If it starts with 0.0, run the math. For more system breakdowns, subscribe to Structural Wealth. We document how money actually moves. This is structural wealth. The architecture is on record.